Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. If you are a stock picker and you do not believe in buying ETFs and just going through that route, you obviously need to have a balanced portfolio. And what that means is you need to have some growth companies in your portfolio. You need to have some dividend paying companies that might be growth companies as well. Okay, you need to have a strategy that hopefully, especially if you are still in your 20s and 30s, and you want to build a portfolio that will basically be around for, I don't know, another 10-15 years. One of the most important thing is to have a balanced portfolio. And one of the ways you can do that is obviously having mature companies that pay you dividends and so on, as well as having a growth companies that could potentially be, give you that boost when it comes to the capital gains. Because remember, what we're after is the total return, meaning the dividend that we get from these companies that we're going to reinvest in our portfolio, as well as the capital appreciation. So companies, I used to own companies like Tesla, for example, a long time ago. And then I took a lot of profit off the table for so many times. And then towards the end, I can't remember, I think 2-3 stocks that were completely free. So whatever I made, I put it back into this portfolio. That's probably why this portfolio is right now in the green, because the money that I made at the time, I reinvested in these stocks that you see right now in front of you. So, and also the dividends that I'm receiving, I'm also basically reinvesting in this portfolio. So in order to grow your net worth and your wealth, obviously you need to have, especially with the stock markets, you need to have a balanced portfolio. So what I want to do today is show you 6 different companies that are so undervalued at the moment that could potentially be a good addition to your portfolio. These companies are expected to grow at least 15% or more every single year in the next 5 years, and they are down quite a bit according to Morningstar. I'm going to show you the financials. I'm going to show you the 6 companies. If you like this type of content, please like the video, subscribe to the channel, and let me know if you have any questions. And again, remember, this is not financial advice. Just this is just what I think. Some of the companies that I think are good addition to your portfolios, or my portfolio and so on. And if you're obviously interested in any of the companies, please do your research before you start investing in any of these companies. Right, so let's have a look at what we're looking for. We're looking for the ticket, the company, the moat, okay, or the economic moat there. And then we're looking for the price, current price. We're looking at the current PE. We're looking at the forward PE, the price, the profit margin, operating margins. We're looking at return on equity, current ratio, to help us understand if these companies have a lot of debt, okay, if they can actually pay off their debt in the next 12 months. And so we need to see if these companies actually have a free cash flow return in the last 10 years. We need to see what the companies are expected to, how much they're expected to grow their earnings in the next 5 years, and then Morningstar valuation and their fair value. Okay, so let's get started. The first company is a semiconductor company. That's AMD. That's the company that's taken over from Intel. When it comes to being the best company, when it comes to anything to do with microchips and so on, right? So this is advanced micro devices. They have a narrow economic moat. Price is $70 per share right now. Current PE very, very high, but if you look in the future, is about half of that, which is quite interesting to see. Profit margin just 10%, operating margin of 11%, return on equity right now is about 5%. Current ratio, we're looking at about 2.2. Anything above 1, that tells us the company can actually pay off their current liabilities or next 12 months in the next 12 months. And they have a free cash flow of $3.4 billion in the bank, which is really good to see. And total return in the last 10 years, if you had this company in your portfolio, you would have made 40% of total return. They don't pay any dividends, so that's just price appreciation, right? Growth estimates in the next 5 years is 15%. Okay, right now they are undervalued almost to 40% according to Morningstar. $115 per share is basically where the price should be, basically, according to this company. But right now we are looking about just $70 per share. Next company is a company that I own in my portfolio, and that is CRM or Salesforce. They have a wide economic moat. The price is right now $129, almost $100 $430 per share. Current PE very, very high, 468. That's ridiculous, right? But PE, we're looking about 20, and we look forward PE, we're looking about 23, which is where the market is right now, especially the technology companies. And profit margin is literally almost non-existent at the moment. Operating margin is quite low. Return on equity is almost non-existent. Current ratio is above 1. Free cash flow $5.5 billion. Total return in the last 10 years, we're looking about 13%. Growth estimate next 5 years is about 15%. And right now it's actually discounted. Basically $220 per share is where it should be. Recently, actually, Morningstar basically not downgraded, but they actually reduced their fair value price. It used to be 240, now it's 220 because of a lot of the things that is happening in the company right now. There's a little bit of uncertainty going on at the moment because 2 of the CEOs have left the company. It will be interesting to find out. Some of these CEOs actually were there because this company acquired the companies they used to own, these guys, okay? So Slack and so on. So we'll find out a bit more information in the next few weeks. I'm doing a full video on this coming soon, so stay tuned for that one. But Salesforce is an interesting company. I mean, the growth is there. They are absolutely amazing company. They have a wide economic moat. They basically, their customers include some of the biggest companies out there. But right now, I'm not sure what's going on. So we'll find out in the next couple of weeks if basically what's going on with the business. The next company we're looking at is CrowdStrike, another one of my favorite companies out there. I do not own this one yet in my portfolio. It has a narrow economic moat. This company deals with a lot of cybersecurity side of things to protect some of the biggest companies, Fortune 100 companies. I think they basically work with about 40 companies in that Fortune 100 companies. Price right now is $114 per share. It has basically no PE yet because they don't have the E part, which is the earnings section. Okay, but forward PE looks okay, 56. Okay, I say okay because this is a growth company, you need to remember. But when it comes to return on equity, profit margins, and return operating margins and all of that, it's actually right now in the negative because they're still growing. They still don't have any earnings, right? Current ratio above 1, which is perfect, and they have almost $600 million in the bank right now. Hopefully that if anything happens, they can use that money, and instead of going to the bank and borrowing a lot more money, and especially when the interest rates are very, very high. Total return in the last 3 years, in fact, this is only for 3 years, is almost a 31%, and they are expecting this company to grow their earnings 59% every single year for the next 5 years. And this is why I actually like this company, and this is why I've included this in this portfolio. And this it's not in my portfolio, but it's in this list. And one of the reasons, if this is basically what you're after, the growth side of it, some people will be willing to hold this company for a long time in order to see that, right? So they take a bet on these kind of companies. Again, if you are looking for a growth company that could potentially be a good addition to your portfolio and so on, it is a good one to look at because cybersecurity is not going to go anywhere, especially what's happening in the world right now, right? And if they can grow their earnings every single year this much in the next 5 years, they will be in a positive very, very soon when it comes to the PE side of things, right? In terms of earnings side of things. So it's an interesting company if anyone is willing to take the risk. And again, it's a huge risk, okay? It might pay off, it might not pay off, but that's the risk reward that you need to think about. But 20%, 27% down right now, discounted right now, $156 per share is where it should be right now, $114 per share. The next company we're looking at is Nvidia, another crazy company that's been up a lot in the last couple of years. It has a wide economic moat, $170 per share. It's gone up quite a bit. It was $120 not long ago, right? 72 PE right now, which is very expensive in my opinion. Forward PE 38 is coming down quite a bit, but profit margin is about 21%. Operating margins up to almost 21% as well. Return on equity 24%. So they are profitable business. They are really a good business, right? Current ratio, they can pay that off 3 times higher, basically what they own right now. Free cash flow, $4.8 billion, almost to $5 billion, which is really nice. And total return in the last 10 years is about 50%. That's ridiculous, all right? Growth expected in the next 5 years in terms of earnings, okay, we are looking about 21%, which is very high for this kind of company. Okay, Morningstar is saying it's about 19% discounted right now. 200 is basically where they expect the price to be. Okay, so it's got less than 30, basically $30 per share to add to that if that was the case. Now, another great company, but the PE seems very high, but according to Morningstar, it's actually basically discounted. And this is the type of business that a lot of people will pay for higher multiples because they know the growth is absolutely amazing, the story is amazing, the company is really good, it is in the right industry, and obviously for that reason they're willing to pay for higher multiples, and that's the end of that story. Okay, not every company will have about 20 PE. Okay, some companies are high growth, and these are one of these companies, right? So the next one is ServiceNow. ServiceNow is very similar to Salesforce. They have a wide economic moat, almost to $400 per share. PE looking about 401, but forward PE is actually lower. Okay, profit margin. Basically, these two companies kind of mirror each other a lot when it comes to profit margins. Return on equity is still in the growth phase. Okay, current ratio is actually enough to cover their liabilities. 1.8, almost $1.9 billion of free cash flow. Return last 10 years, we're looking about 30% almost, but 26% growth expected for the next 5 years. Okay, every single year, 26%. That's quite nice. Okay, apart from CrowdStrike, that's the highest that we've seen in this group, and it's almost 40% down. And $640 per share is where it should be, but right now is only about $400 per share. So another interesting company. Okay, if you are looking for high growth stock and you're willing to take the risk, then do your research about ServiceNow. That might be a good addition to your portfolio. The final one, and basically one that I had to include in this list, is Tesla. Tesla has a basically narrow economic moat, $174 per share right now. It has a quite PE that's actually not as bad as it used to be. It used to be in the thousands, and now we're looking about 53 PE. And the next basically 12 months, we're expecting it to be about 30, almost 36 PE. That's very, very low multiple for a company that is growing so much. Profit margin is actually nice, almost 15%. Operating margins are almost 17%. Return on equity, 32%. Can you imagine? That's Tesla. Not long ago, this company was actually not making any money. They didn't have a PE. And look at it now. They actually do. So this is one of the reasons why when you take basically a risk in owning some of these companies, okay, in the long run, it will pay off. Because if you are right and the analysts are right, it will pay off, trust me, okay? But again, do your research because these are very speculative companies, so you have to be careful. Current ratio above 1, which is basically 1.5, so it's really good. Free cash flow, almost $9 billion. That's perfect. Return on it, basically investment, but total return in the last 10 years, we're looking about 55%. That is absolutely amazing. And I like how I've always said to you guys, majority of the money that I made in the last basically 3 years came from Tesla, trading Tesla in and out. Okay, but look at the growth expectation for every single year in the next 5 years, 48%. If these analysts are actually correct, that is absolutely huge growth. And when you look at the Morningstar valuations, we're looking about 30% discounted right now. $250 per share is where apparently it should be. Now, in terms of growth, I know recently, basically the Tesla Model Y, I think it is, basically kind of slowed down production because of obviously they were slowed down, but China was not actually buying as many of those models as basically before. Obviously, because of recessions and things like that, they might be just that. It might be other reasons. Whatever it is, we'll see what happens. But this is a great company, no doubt. And I've always said this, okay? The PEs might be a little bit too high, but this is definitely a great company. and I am planning to look at it again in more detail in the next couple of weeks. And if the numbers are fine in terms of the revenue, in terms of expectations, in terms of like the how many factories they've got, the projection for actually how many cars they sell in the next few years. So I'm going to look at it deep down into every single product that they sell, how much they're expected to sell, how they're doing in different countries, where the competition is, and so on. And if everything is tick, 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 then I might be adding this to the family portfolio. Because the family, one of the things that I'm doing with the family portfolio is buying companies that should be around for a long time, basically around for a long time. Companies that I'm not doing a lot of dividends kind of stocks, if you like. Some of them they are dividend paying companies, but majority of the companies there should be growing companies, because their portfolio is for my children. And hopefully by the time they are old enough, these companies will be around and they will be a great companies. Now, I don't know what's happened there, so the formulas have now changed slightly. I think things updated, but I'm going to stop the video right there. Okay, I'm just go back to the portfolio. But those are the 5-6 companies I wanted to share with you guys today. But please do your research. Although Morningstar is saying it's undervalued at the moment, don't just rely on that. Go and do your research. Like I said, if you're interested in Tesla, find out how many cars they're supposed to sell this year and how many they sold. How much are they going to sell the next few years? Okay, what the deal is in terms of those kind of things. Go to Salesforce website and find out who their company, who they work with. Okay, do they have recurring revenue, which is basically one of their major things, right? So look at those things and find out as much details as you possibly can. Now, just to be transparent, I do own Salesforce, which is on that list. Like I said before, I used to own Tesla, but I don't have it anymore. The only two non-dividend paying companies that I own in this portfolio is Salesforce and Adobe. And those two companies are actually great. I want to include Adobe on that list, but obviously there were other companies that were growing a lot faster, so for that reason I've taken it out. But I do like all of these companies, especially this one here, CrowdStrike. I might be adding that to the family portfolio as well as Tesla very soon. So that's it for today. I hope you like this kind of content. I've got this weekend, I will be doing a lot more videos. So if you like this kind of content, if you are new to the channel, please subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.